Hello and welcome to the Plain English Finance Podcast, the podcast dedicated to helping you make smart financial decisions. I'm your host, Tré Bynoe, certified financial planner, chartered investment manager, financial planner with TC Wealth Management and Visa Wealth. For more details or to send in your questions, check out the show notes at trebynoe.ca/podcast. If you want to learn more about me, start with episodes 1 and 2. Okay. This episode is on notional accounts within a corporation, and frankly, I'm going to try to keep it shorter because...
I like that you look at the clock like it's not going to happen.
No, it will, because I hope it does. Anyway, okay. I'm going to start by saying we're doing this just after we did the last episode where I explained how dividends work.
Yep.
And you had the non-eligible and the eligible dividends. If you do not understand what I just said, you need to go back and listen to that episode before we do this.
Like I need to?
Well, we just did it in person, so
okay.
Hopefully you remember. Hopefully it was 10 minutes ago. Hopefully you remember.
No, I know.
But no, as an audience, because this goes straight over your head if you do not understand that. Like that small section about non-eligible and eligible dividends.
Is it possible for you to do a very quick recap on that?
No, they have the whole episode.
Okay.
You can go back and watch it. Listen to it. Okay. So I'm also going to use the same example that we used in the last one as well with this $100 guy.
Oh, that's perfect.
Okay. Even more reason if you want to go back and listen to it.
Yeah.
First off, there are 3 main accounts they're called notional accounts because they don't really exist. They're not bank accounts. They are just numbers that the government keeps track of.
Okay.
Okay. There's something called a CDA. It stands for Capital Dividend Account.
Okay.
Okay. There is something else called a nerd a nerd account.
Wow.
No, it's
I thought that was the acronym.
Yeah, it is. So
okay.
NERDTOH is the non-eligible refund dividend tax on hand account.
Okay, I've heard you say RDTOH.
Yeah. And then there's a refundable, like an eligible. So there's non-eligible, then there's the eligible version of that account. So 2 versions of that account. Okay.
Yeah.
So 3 accounts. We're going to start with the capital dividend account. The government utilizes it for a few things, but basically this is what it's for. So we looked at the tax brackets, which I can bring back up here. And do you remember how capital gains was taxed? Remember I said that was an important step, that half of it, remember it was half, okay?
Yep.
So you're only taxed on half of it.
Yep.
The same applies within a corporation, okay?
Yep.
So the way that it works is this guy, let's say, we're going to say $10 for easy math as a capital gain in investments. He puts there's $80 into the markets, it earns $10. Okay. He then sells it. So he has a $10 capital gain.
Yep.
In a corporation, $5 of it goes to the CDA account. So it gets recorded, increases the capital dividend account. The other $5 of it gets added to the other income. Okay. Basically. This $5 that's in the capital dividend account can be paid to the shareholder with no tax applied. And that's the 50% that is
not taxed.
That is not taxed.
Yeah.
The other $5 goes through a system with the eligible dividend accounts that we'll go through. And that gets taxed at a higher rate than otherwise a similar type of income would be taxed.
Yeah.
So in a corporation, the notional accounts are there to, again, try to equalize this unfair advantage. The CDA is how we manage capital gains. The non-eligible and the eligible are where it's a notional account that when you earn certain types of income within a company, within a corporation, they take a temporary tax, and that tax is refunded to you when you pay the corresponding dividend. So for the eligible refundable tax on hand, when you pay an eligible dividend, you get refunded some of that balance.
Yep.
When you pay a non-eligible dividend, the non-eligible version, you get a refund from that account. And these are notional accounts. They don't really exist. But they're there to temporarily keep tax.
Okay.
Does that kind of make sense?
That last part you were talking about, you lost me.
Okay, I'm going to walk through an example with this guy.
So is this corporate tax?
Yeah.
This is
the corporate tax part. Yeah.
Okay.
So
only corporations have these
yeah
secret accounts.
Yeah, basically.
Okay.
So we're going to...
Do they know about them?
Depends. They should do, but some don't. Okay, so we're going to say that this person the corporation receives $100 as a Canadian dividend, Canadian eligible dividends. Keep it really simple. 33% of that goes to the eligible version of the NERD account. Non-eligible refund tax on hand. This is the eligible version of it. So the refundable tax on hand account.
Okay.
33% of it goes there.
Okay.
That 33% goes there whether this individual pays the money out to a shareholder or not. So this is when the company earns this $100 in a Canadian dividend, the company will pay 33% taxes on it.
Okay.
That means that the individual can then go back and invest. They have $67 left to reinvest into the markets. Okay. So they end up with $67 reinvested in the markets, and then their eligible refund tax on account has a balance of $33 in it.
So they haven't actually paid that to the government?
No, this has been paid. This is paid, but it goes into this account. Okay. When this corporation pays out a dividend of $100, the government says, okay, you paid this $33 and you can get this refunded, basically.
Okay.
So now when the corporation pays out $100 to the shareholder, the government says, we'll give the corporation back $33. That was in this refund account because personally, the individual is going to pay $33-ish of tax.
Okay. That seems like such a weird
way to do it.
Yeah.
The reason is because otherwise, remember, the whole system is designed to try to make it as fair as possible. It's not perfect, but it's try to make it as fair as possible. Mm-hmm. Otherwise, what would happen is this individual would pay no tax at the corporate level, and the result of being able to invest a full $100 again and again and again, like I'm using $100, but now picture this at millions of dollars.
Yeah,
it would be it's already unfair. There's already big tax advantages. It would be very, very unfair. So this is their way of trying to even that out. So this is the way that an eligible Canadian dividend gets paid. Does that kind of make sense?
Yeah, it makes a lot of sense. Yeah.
Okay, so that's an eligible dividend.
Okay.
For a non-eligible, let's say it's $100 of interest income now.
Okay.
So I just looked at Canadian dividends.
Yeah.
Let's say I'm going to now use $100 of interest income.
How would you get interest income?
GIC.
Okay.
Yeah, have a GIC and you'll see why I'm like, don't hope GICs in corporations. Okay, so in principle, this is the way that it works. So company gets $100 as a GIC, as interest. The government says, no, this is passive income. We're going to tax it at 50%. Yeah. Nice.
Is that real?
Yeah.
Oh, wow.
Yeah.
It's like 51.73.
Basically 50%. So of this 50%, they say same principle applies. We will, okay, these numbers are not real. I'm using this for example. But we're going to say, I'm going to put 30% of this. So 30% of what you paid into the refund on hand account, refundable tax on hand account.
NERD account?
Yeah.
That's what we are calling it from now on.
Yeah, that's what I call it. But the other 22% is gone. I'm keeping that. You ain't getting it back.
The government.
Government, yeah. I'm keeping it. True. Don't use GSEs in corporations. Keeping it. Okay.
Okay.
So what ends up happening here is this individual now has $48, $8 left out of this $100 that he got in interest. But he has this $48 plus this $22
I thought that was gone.
Oh, sorry, yeah, you're right. Here you go. Plus this $30 sitting in the refundable tax on hand account. Okay.
Yep.
So when he pays out a $100 dividend, the government basically says, hey, we'll give you back this $30 of tax that you paid. So $30 goes back into the corporation, a refundable amount, but you still only end up with like this 48 plus this 30.
Yeah, 78.
Yeah. I can't write this. No, that's backwards $78.
You're like trying to write it at an angle.
I know, yeah. So they only get, so you end up, once it hits the personal level, you're only getting $78 back versus with the Canadian dividend, at the end of the day, you're getting the full $100 with the $100 refund.
Right. Gotcha.
So that's the way that it's taxed. That's what they're for. That's what these notional accounts are to basically hold tax temporarily to encourage companies to get the money out of the company.
Yeah, because they don't want. Okay, yeah, the unfair advantage thing.
Exactly.
Right.
So oftentimes what I'll see is, especially when somebody doesn't have a dividend strategy, is people will earn investment income within a corporation, oftentimes the wrong type or whatever it is, and they will build up these notional accounts and they should be clearing them out. And the reason they should be clearing them out is they should be paying dividends to get rid of them, is because this temporary tax doesn't increase with inflation. So inflation kind of decreases the amount of the refund over time. So $33 as a refund today is very different than $33 of a refund in 20 years.
Absolutely.
Right?
Yeah.
And because this amount doesn't change except by having more income and interest and stuff inside of a corporation, then it's we call it tax drag. It's a inefficient way of investing an amount of money inside of a corporation. So you want to be clearing them out, especially when you get a higher refund, which we're not going to go into that, but that's the essence. That is the essence of these refundable tax accounts, is to try to, as part of the integration, make it as fair as possible. In 2019, you used to be able to put interest income. There was only one type of refundable tax on hand, so you could put it through and take it as an eligible dividend, which meant that you could eventually pay less tax on interest income.
Okay.
That changed. So a lot of people had these big portfolios pushing out interest income and things like that, and it wasn't as big of a deal back then because the tax code allowed for it.
Yeah.
But now it does not. Now it's very punitive because they changed the way that this works.
Okay. Yep.
That's notional accounts, basically.
Okay, that wasn't so bad. I don't know why that word was just like, oh, maybe because I had no idea.
Yeah, it's not that complicated. I'm trying to simplify it. There's a lot more to it, but that's in essence what they are trying to do. That's what they're for.
They're saying like you have to pay your tax, right? You can't just put all your gross income into the markets all the time.
Yeah,
like
it's too much of an advantage.
Yeah.
So we're going to keep some of it. And there are other things. So they made these things and now they use them for other types of events. So, you often hear, or I complain a lot about, like insurance being missold to various people for lots of things. The way they sell it is because, for example, a death benefit, all else being equal, a death benefit will go to the CDA account, the capital dividend account. So therefore, it gives you the opportunity to pull money out of a corporation, in essence, tax-free.
Okay.
So that mechanic is used for a variety of different things now, but it was designed for capital gains. That capital dividend account is money that can be pulled out. Lots of reasons that stuff goes in there, but they're the big ones, is capital gains and insurance, and then you can pull that money out without paying tax on it.
Mm.
People like to hate on insurance stuff. It has its place for the right situation.
Entire.
Yeah, but a lot of stuff has to line up. Unfortunately, it's more often done wrong than right, I would say, in my experience. I would say it's vastly oversold, but it does have its place. There's a reason it has its place. But I would say the only time I encourage going down that route is once you have everything you need for your lifetime plus some, and you are truly planning for the next generation. But we'll do an insurance episode as well at some point, so we'll get into that then. But
Perfect. That wasn't too bad. What are we at? Just over 15 minutes ish, I think.
good.
So there you go.
Now you just have to explain it back to me.
So is it notional? Is that
Notional? Yeah.
a notional account? Is like an imaginary account where the government takes their percentage and sets it aside so that you can't just have all that gross income and invest it into the markets. And if you do is it the eligible one? Sorry, you showed me two examples.
The eligible one is where
sorry.
Canadian companies will pay into.
Yes.
Yes.
Sorry, I think I'm thinking because you said if the company invests in like the stock market or something like that versus if the company invests in fixed income.
Yeah. That's the two
where
examples I gave. Yeah.
Okay.
Yeah.
Is that good enough? What else?
Yeah, I think that's pretty good.
Okay.
Yeah. I think that
I
that
guess
illustrates
that
I'm always thinking of like, okay, I could probably be a little bit more like clarify a little bit better there or here or there, but I think that illustrates what they're for and why it's important to be on top of them pretty well, would you say?
I think so.
I think so. Okay.
I think I did.
It's a hard line because I have a ton of numbers here that I could go through exactly how it works, but I don't know if that's actually going to be valuable.
No, that's okay.
You're like, no, absolutely
that's
not.
okay.
No, it's fine.
Let's do a fun episode for the next one.
Yeah, it's okay. Yeah, hopefully that makes sense. I can go into more if I need to, but we'll leave it there. It'll be a nice short episode.
Yay.
Okay.
Awesome.
Good. See you guys in the next one. Oh, the next one is going to be on.
We might be changing this depending on what it is.
It was going to be talking about a financial planner's viewpoint of CBP versus an accountant's view of CBP.
You need an accountant for that. Don't you think that would make more sense? I shouldn't be in that episode. We'll do a fun one for the next one.
No, that I think you'll find an accountant would. Not all of them. There's tons that are coming around to the way that financial planners view it, but yeah, I don't know. Okay, well maybe we'll do a different one then. I don't know what you want to do.
We'll see. No, I'm just bugging you. We'll see.
Because I have a list of like 50 here, so we can pick a different one if you want to.
Yeah.
But okay, well the next one will be the next one.
Yeah.
Okay, see you guys later.
Bye.
Bye. Okay, it's Trey here. Don't tell Cease. I'm actually going to go over a few numbers. I was thinking about it last night and I felt like it's just the right thing to do. Okay, so if you are watching this on YouTube, on my screen, you will see some comparisons. And if you're listening to this, go check out the YouTube version. But basically, it compares income in different types. So you have interest income, foreign dividends, eligible Canadian dividends, and capital gains. And for simplicity, this is all taxed at the highest marginal personal tax rate. But you'll see it's comparing $10,000 earned of each type of income. So I'll go through them. So the interest income, the corporation gets $10,000. The shareholder at the end of it, though, gets to keep $4,207 of it. That means there's an effective tax rate of almost 58%. Yeah. But along the way, you'll see there's a refundable corporate tax. And this is those refundable tax on hand accounts that I was referring to. And then we have foreign dividends. Again, $10,000 of income. What do they end up with? Even less. $3,585. That's almost a 64, just over 64% tax rate. That's insane. Now the good stuff. And this is why it's so important. So eligible Canadian dividends, same $10,000. What does a person end up with? $6,066. That's an effective tax rate of 39%, significantly better than the other types of income. Then we get capital gains. What's the effective tax rate? 28.97%. $10,000 is what they start with. They end up with $7,000. And that is why there comes to a point in wealth creation, especially, and it's so even more important when you're dealing with like non-registered money or corporations, investing within corporations, that where you hold your investments almost matters more than what you hold. So if you are out there trying to have the chance of beating the market by 1% over a 10-year period, you would guarantee yourself better results by guaranteeing that you save taxes. Simple as that. So it's about where you put your focus and your effort. This is a place that makes big, big differences long term, not even including the fact that capital gains can be deferred. It's not even like interest income can't even be deferred. It's what it is, but capital gains, you can defer it to future years. Again, how you build a portfolio when you are at this stage of wealth creation makes a big difference. So do it right. Anyway, don't tell cease. Bye. Thanks for listening to this episode of the Plain English Finance Podcast. Tré Bynoe, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities offered through Aviso Wealth, a division of Aviso Financial Inc.